Okay, so to start today, I want to try a little psychological experiment with you
Okay,
and with everyone listening.
I'm in. Let's do it.
The phrase is financial risk.
Uh,
I mean, the kind of asset that, keeps you up at night. You're sweating about your portfolio, checking your phone every 5 minutes. What's the first thing that pops into your head?
oh, that's an easy one. I mean, for the last, 10, maybe 15 years?
Yeah.
The standard answer from almost anyone on Wall Street,
Right.
or Main Street for that matter, is cryptocurrency, specifically Bitcoin.
Exactly. Bitcoin. It's the casino, the Wild West.
It's the poster child for volatility, the thing your financial advisor warned you about.
Okay, so now let's flip the coin. What if I say safe haven? Sleep well at night, bedrock, generational wealth. Where does your mind go?
You go to the classics. The shiny rocks, gold and silver.
Of course.
They've been money since, I don't know, the Roman Empire. They're what you buy when you're terrified of everything else. They're supposed to be boring.
Right. Boring is good. Boring is safe. But here's where it gets really, really interesting. We're looking at data from late January 2026.
Yes, specifically Thursday the 29th and Friday the 30th.
And let me tell you, the script didn't just get flipped, it got absolutely shredded.
It was a total anomaly. We witnessed a market event that I think we're going to be studying in finance textbooks for a long, long time. We saw the so-called adult in the room
Gold and silver.
lose their minds.
We're talking about a crash in precious metals that makes a bad day in crypto look like a walk in the park. We have sources showing double-digit losses in a single trading day.
It was chaos, total chaos. And that's exactly our mission on this deep dive. We
Yeah.
need to unpack this. Why did centuries-old assets drop like a stone? What does this mean for that tired old argument about crypto's volatility? And the big question is, are we seeing a fundamental shift in what investors can even consider safe?
We've got a massive stack of sources today. We're looking at financial analysis, market data, tweets from heavyweights like Da Vinci Jeremy, and some fascinating analytics from firms like Sentiment
So let's dive in.
to really get how crazy this crash was. And I mean, crash is the only word for it. We have to set the scene.
Absolutely.
Because this didn't happen in a vacuum. If you rewind to early January 2026 or even late 2025, the world looked very different for metals investors, didn't it?
Oh, completely different. You have to remember, 2025 was widely called the year of precious metals.
That wasn't just a headline.
No, that was the reality. Everyone was piling in, and that momentum just carried right into 2026. If you were holding gold or silver in those first few weeks of January, you were feeling like a genius.
The smartest person in the room.
Exactly.
So give us the numbers here. How high were we flying before the engines just cut out?
Okay, let's start with gold. It entered 2026 trading at around $4,300 an ounce.
Which is already a huge number.
A massive number, historically. But driven by, geopolitical tension, a declining dollar, the greenback gold just went parabolic.
Parabolic is a word we usually say for meme coins, not a rock in a vault.
And that's why this is so unusual. By Thursday, January 29th, gold hit an all-time high of $5,600.
Wow.
Just do the quick math on that. That's a 30% increase in the price of gold in one single month.
30% in a month.
For a mature, multi-trillion-dollar asset class, that is like virtually unheard of. Gold usually moves in inches. This was moving in miles.
That is massive, but I heard silver was even crazier.
Oh, silver was behaving like a tech stock in the dot-com bubble. It was unrecognizable. It started 2026 at $72 an ounce.
Okay.
By that same Thursday peak, January 29th, it hit $122.
Wait, hold on. Let me get this straight. It went from 72 to 122.
That is a 70% surge.
Yeah.
In under 30 days.
That's unbelievable. So everyone's popping champagne. The gold bugs are taking victory laps on Twitter.
The sentiment was euphoric. And as any trader knows, extreme euphoria is usually the most dangerous time in any market, when everyone is convinced it can only go up.
Look out below. And then Friday happens. Or late Thursday into Friday.
It started late Thursday, and it just bled into Friday. And correction is not the right word. A correction is a gentle dip. This was a liquidation event. The sources describe it as quite the opposite and brutal.
It wasn't a slow leak, it was a cliff.
Exactly.
So walk us through the damage. What did those 24 hours of chaos look like?
Okay, in a single trading window, gold plummeted from that $5,600 high all the way down to $4,700.
That's almost $1,000 an ounce wiped off the top, just gone.
It's a 16% decline in a single day. Now, if you're a crypto trader, you might say, 16%? I've seen worse.
Right, on a Tuesday.
But for gold, that is statistically so rare. It's a 5 sigma event. It's not supposed to happen to the asset that backs central banks.
But silver. Silver was where the real slaughter happened, right?
Silver was a bloodbath. I don't use that word lightly. It dropped from that high of $122 down to 73.
73. But you said it started the month at 72.
Precisely. You nailed it.
Yeah.
In 24 hours, silver erased almost all of its yearly gains. That is a 40% drop in one day.
40%.
Imagine holding an asset because it's safe for wealth preservation. You go to sleep Thursday, up 70% on the month, and you wake up Friday and 40% of its value has just evaporated.
That sounds terrifying. It's the kind of thing that wipes out leverage traders instantly. Did they bounce at all?
A little dead cat bounce, as they say. Gold clawed back to 4,900, silver to 85, but they still ended deep, deep in the red. The charts look like a skyscraper, straight up, then straight down.
It's the sheer scale of the money loss that just blows my mind. We're not talking about a small cap stock crashing here.
We're talking about numbers that are hard for the human brain to even comprehend. There was a tweet from Da Vinci Jeremy. He's a very early crypto adopter, and he put it in perspective. He said, gold and silver erased $6.7 trillion from their market cap in 30 hours.
6.7 trillion with a T.
Let me try to contextualize that number, because we throw trillion around way too loosely. 6.7 trillion is larger than the GDP of almost every country on Earth.
More than Germany or Japan's entire economy?
It's vanished into thin air.
And the source material makes a specific comparison to crypto here that I think is the key to this whole story.
Right. The source points out that this loss, just the money lost by gold and silver in one day, is roughly 2 times larger than the entire crypto industry at that time.
Okay, let me just restate that to make sure it lands. So if you took every Bitcoin, every Ethereum, every single altcoin, added it all up, and then doubled it, that's how much value just disappeared from the safe haven metals market.
Yeah. Yes, that's exactly right. Bitcoin's market cap was around 1.64 trillion at the time. The entire crypto market, maybe 3 trillion. Gold and silver lost double that in a day.
That completely flips the narrative. I mean, critics always say crypto is immature, it's unstable. But here, the adults in the room, gold and silver, are acting like volatile penny stocks.
That's a massive irony.
Yeah.
And to be fair, we have to acknowledge, crypto wasn't immune during this.
No, that's true.
The sources note Bitcoin did drop. It went from over 90,000 to around 81,000.
Sure, a 10% drop, that hurts.
It's not trivial. But let's look at the context.
Yeah.
Bitcoin is, what, 17 years old at this point?
Yeah, born in 2009, a teenager.
Right. It hasn't even graduated high school yet in financial years. You expect a teenager to be a little volatile.
Yeah.
Gold and silver have been traded for 5,000 years. They're the grandparents. For the safe havens to fluctuate this wildly.
40% drop for silver.
That's the real shock. That's the untypical volatility our sources are talking about.
It reminds me of that quote from CZ at Binance. He pointed out that Bitcoin is a 17-year-old technology, heavily suppressed in most of its existence.
And he added, we are still early. The implication being Bitcoin is still finding its price. Gold should have found its stable price centuries ago. When the bedrock starts shaking more than the skyscraper, you have to question the foundation.
It really does make you rethink your strategy. And speaking of strategy, before we dive into the why, because I know people are dying to know what caused this, we have to take a quick second.
That's right. Whether you're seeing these dips as terrifying or as a buying opportunity, you can't do anything if you're not set up to trade.
Exactly. If you're on the sidelines thinking, I want in, you need to be on the right platforms.
We see this all the time. People panic, but they haven't done the registration. Don't wait for the market to move to start filling out paperwork.
So here's your move. If you haven't already, go register on the exchanges. We've made it super easy for you. All the relevant links you need are located right in the description under this video. Go get registered and be ready.
Preparation is half the battle. Don't get caught just watching.
Okay, let's get back to it. $6.7 trillion gone. Why? Was this just a bubble popping or was something else going on?
It's the multi-trillion-dollar question. The sources point to a few things. The most obvious is just old-fashioned profit-taking.
The sell high part of the equation.
Exactly. I mean, these assets went up 30 and 70% in a month. They were screaming overbought. When you have that much profit on the table, the big players, the hedge funds, they start cashing out.
But a 40% drop feels like more than just profit-taking. That feels like panic, like someone shouted, fire!
Agreed. It was a stampede. And that brings us to the political factor mentioned in the analysis. There was a lot of speculation about Donald Trump's nominee for the next Fed chair, Kevin Warsh.
Okay, now we have to be clear here. We're not taking a side on whether Warsh is good or bad. We're just looking at how the market reacted to the news.
Precisely. Markets hate uncertainty. And analysts cited his nomination as a potential market mover.
So what's the connection? Why does a Fed chair pick crash the price of silver?
It comes down to the dollar. If the market believes a new Fed chair might strengthen the dollar or be more hawkish on interest rates, that hurts the appeal of gold and silver.
Right, the anti-dollar. If the dollar gets stronger, you don't need the hedge as much.
That's the traditional logic.
Yeah.
The trading algorithms read the news, they anticipate a stronger dollar, and they just sell the metal. But there's another angle that I found even more fascinating.
What's that?
The analytics firm Sentiment weighed in. They highlighted a debate about rotation.
Rotation?
Yeah, a theory that investors were taking those huge profits out of precious metals and rotating them into crypto.
And probably selling gold to buy Bitcoin. That's like a Yankees fan rooting for the Red Sox.
It's what's being speculated. Sentiment's quote was great. They said, as debates have circulated as to whether precious metals would see their profits begin to move into cryptocurrencies, this certainly wasn't on many people's bingo cards.
I love that. Not on the bingo card. Because usually when gold crashes, people flee to cash. Fleeing to digital assets is a huge paradigm shift.
It is, and Sentiment praised Bitcoin's resilience here. While silver was diving 40%, Bitcoin's drop was, relatively managed. It suggests the crypto market was acting more rational than the metals market.
Which brings us to the bigger picture, this whole idea of stability versus volatility. This event just turns it on its head.
It absolutely complicates the narrative. The lesson here is about untypical volatility, where you least expect it. We're taught gold is the safe harbor, but what we saw was the harbor itself catching fire.
That's a great image. And for our listeners, this is crucial. It challenges that idea that you can just put money in gold and ignore it.
Right. Passive investing in safe assets isn't risk-free. If you were leveraged in silver thinking it couldn't lose 40% in a day because it's silver, you got wiped out.
And I want to circle back to that market cap comparison one more time, because crypto gets slammed whenever there's a liquidation event. Oh, $1 billion was liquidated.
Every time. Bloodbath in crypto. And here we have 6.7 trillion vanishing from metals. The source notes Bitcoin liquidations were around 1 billion during this. 1 billion versus nearly 7 trillion.
It puts things in perspective. The danger of crypto is highlighted because it's transparent, but the safety of traditional finance might be an illusion.
Or at least the gap is closing. Maybe legacy markets are becoming susceptible to the same shocks that drive crypto. The walls between traditional and digital finance are getting thinner.
So 2026 starts with a bang. Gold and silver go to the moon and then crash back to Earth, while crypto looks surprisingly resilient.
It was a historic trading week. One for the books.
As we wrap this up, I'm left wondering, if the bedrock isn't solid, where do you put your safe money?
And that's the provocative thought I want to leave everyone with. If the oldest forms of money on Earth can lose 16% to 40% of their value in 24 hours, does the term safe haven actually mean anything anymore?
That's a scary thought.
Or, to take it a step further, is everything just a risk asset now? Are we in an era where there's no such thing as risk-free, only different flavors of risk? If gold can crash like a meme coin, maybe the only safety is in being agile, not in hiding.
Man, that is something to chew on. Everything is a risk asset.
Indeed. It's a brave new world.
Look, we want to know what you think. Was this a freak accident, or is gold losing its status? Let us know in the comments. And hey, if you found this deep dive valuable, do us a huge favor.
It really helps the show.
Please subscribe, like the video, and hit that bell icon. That way you don't miss out when we drop the next deep dive into these crazy markets.
Thanks for listening.
We'll see you in the next one.